Before we conclude, it is essential to address the regulatory framework that protects investors. Please pay close attention to the standard warning issued by the Securities and Exchange Board of India, commonly known as SEBI. As seen on this slide, there is a critical mandatory disclosure that every investor must understand. The core message is this: mutual fund investments are subject to market risks. This means that the value of your investment can go up or down based on the performance of the financial markets. There is no guarantee of returns or protection against loss. Furthermore, it is a requirement that you read all scheme-related documents carefully before investing. These documents contain vital information regarding the fund's objectives, risks, and fees. Understanding these details is the most important step in making an informed and responsible investment decision. We emphasize transparency and caution as the foundation of your financial journey. Welcome to this presentation on the fundamentals of mutual funds. Today, we will explore how these investment vehicles work, the various types available in the market, and how they fit into a diversified financial portfolio. Whether you are a student of finance or an individual investor, understanding these structures is key to effective wealth management. Let us begin. At its simplest level, a mutual fund is a financial vehicle that pools money from many investors to purchase a diversified portfolio of securities. When you invest in a mutual fund, you are buying shares or units of the fund, which in turn owns stocks, bonds, or other short-term debt. This allows individual investors to access professionally managed portfolios that would be difficult to construct on their own. The process begins when investors contribute capital to the fund. This pool of money is then managed by a professional fund manager or an investment team. These experts decide which securities to buy and sell based on the fund's specific objectives. The income generated through dividends or interest, as well as any capital gains from the sale of securities, is then passed back to the investors after deducting the fund's operating expenses. There are four primary reasons why mutual funds are popular. First is diversification. By owning a variety of assets, the risk of a single stock performing poorly is mitigated. Second is professional management. You benefit from the expertise of full-time analysts. Third is liquidity. Investors can typically sell their units at the current net asset value on any business day. Finally, affordability. Many funds allow you to start investing with relatively small amounts of money. The value of a mutual fund is expressed through its net asset value, or NAV. To calculate this in English terms, the NAV equals the total market value of all assets minus total liabilities, divided by the total number of outstanding shares. This figure represents the price per share of the fund and is typically updated at the end of each trading day based on the closing market prices of the underlying securities. Equity funds are the most common type and primarily invest in stocks. Their main objective is long-term capital growth. Within this category, you will find large-cap funds focusing on established companies, mid-cap and small-cap funds targeting faster-growing businesses, and sector funds that specialize in specific industries like technology or healthcare. These carry higher risk but offer the potential for higher returns. Debt or fixed-income funds invest in government bonds, corporate debentures, and other money market instruments. These are generally considered lower risk than equity funds. Their primary goal is to provide regular interest income and capital preservation. They are an excellent choice for conservative investors or those looking to balance out the volatility of a stock-heavy portfolio. Hybrid funds, often called balanced funds, provide a middle ground by investing in a mix of both equities and debt. The proportion is adjusted based on the fund's target risk profile. For example, an aggressive hybrid fund might hold 65% in stocks and 35% in bonds. This structure aims to provide a blend of growth potential and income stability in a single investment. Fund managers generally follow two philosophies. Growth investors look for companies expected to grow sales and earnings at a faster rate than the market average. Value investors look for the bargains, companies that appear undervalued by the market based on their fundamental worth. Many mutual funds explicitly state which philosophy they follow in their prospectus, allowing you to choose one that aligns with your outlook. Mutual funds are also categorized by their structure. Open-ended funds are the most common. They issue and redeem shares on demand at the current NAV. There is no limit on the number of shares. Closed-ended funds, however, issue a fixed number of shares through an initial public offering and then trade on an exchange like a stock. In a closed-ended fund, the price is determined by market supply and demand rather than just the NAV. Active management involves a manager trying to outperform a specific market index through research and timing. Passive management, often seen in index funds, simply seeks to track or mimic the performance of an index like the S&P 500. Passive funds generally have much lower operating costs and management fees because they require less manual intervention and research. Every mutual fund charges an annual fee to cover operating costs, known as the expense ratio. This is expressed as a percentage of the fund's daily average net assets. For example, if you invest $1,000 in a fund with a 1% expense ratio, $10 goes toward management costs annually. Over the long term, even a small difference in the expense ratio can have a significant impact on your total investment returns. In the world of investing, risk and reward are directly related. Money market funds are at the bottom of the risk scale with lower returns, followed by debt funds, hybrid funds, and finally equity funds at the top. It is vital to assess your own risk tolerance, meaning your ability to handle market fluctuations, before deciding which percentage of your capital to allocate to each category. A systematic investment plan, or SIP, is a popular way to invest. Instead of a large lump sum, you invest a fixed amount regularly, such as once a month. This strategy utilizes rupee cost averaging or the dollar cost averaging. When prices are high, your fixed amount buys fewer units. When prices are low, it buys more units. This reduces the average cost per unit over time and removes the need to time the market. Returns from mutual funds are generally taxed as capital gains. Short-term capital gains apply if you sell your units within a specific period, usually 1 to 3 years depending on the fund type and local laws. Long-term capital gains apply to holdings kept beyond that period and often benefit from lower tax rates. Dividends received from the fund may also be subject to tax, so it is important to consider the after-tax return of your investment. Before choosing a fund, you should evaluate several factors. First, the fund's historical performance over 3, 5, and 10 years. Second, the experience and track record of the fund manager. Third, the fund's assets under management. And fourth, the portfolio turnover ratio, which indicates how frequently the manager buys and sells securities. High turnover can lead to higher transaction costs and tax liabilities. Building a portfolio involves asset allocation. You should spread your investments across different fund types based on your financial goals, such as retirement, buying a home, or education. A younger investor might have a higher allocation to equity for growth, while someone closer to retirement might shift toward debt funds for safety and regular income. Avoid common mistakes like chasing last year's winner. A fund that performed best last year may not do so this year. Another pitfall is ignoring fees. High expenses can eat into your profits. Additionally, avoid over-diversification. Owning 20 different mutual funds often leads to overlapping holdings, which doesn't actually reduce your risk but does increase your complexity. Mutual funds are strictly regulated by government bodies, such as the Securities and Exchange Board or the Securities and Exchange Commission. These regulators ensure transparency, mandate regular disclosures of holdings, and set limits on the fees funds can charge. While regulation does not protect you from market losses, it does protect you from fraud and ensures the fund is managed according to its stated objectives. In summary, mutual funds offer a convenient, transparent, and diversified way to participate in the capital markets. By choosing the right mix of equity, debt, and hybrid funds, and by staying disciplined through systematic investing, you can work toward your long-term financial goals. Thank you for your time, and I wish you the best in your investment journey.